In this month's economic update, Kaplan Professional Education's Trevor Trahan speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly economic update. I'm Trevor Trahan, and this month we're speaking with ANZ's economist Katie Hill. Thanks for joining us today, Katie.
Pleasure to be here.
The ANZ Roy Morgan Consumer Confidence Rating has just fallen to its lowest level in a year. What caused this?
Yeah, so we saw consumer confidence drop quite sharply in the last 2 weeks, and that's mostly due to concerns around the Greek debt crisis and also volatility in Chinese share markets. And really, it was really quite a sharp turnaround. Before that, we had actually seen consumer confidence improving. That was reflecting a positive reaction to the Commonwealth budget. I think the bigger picture point to take away is that really households remain quite fragile at the moment. And so that's amid high debt levels, weak wages growth, and really quite a high level of job insecurity. So while households are so fragile, we're just seeing this heightened sensitivity to any bad news. So whether it's around federal budget cuts, market volatility, or announcements of job losses in the press.
What is your outlook for Australia's inflation rate over the next 12 months? Further, what are the major aspects which will impact Australian inflation?
So we think that below trend growth in the economy as well as weak wages growth is going to keep inflation contained and pretty much right in the middle of the RBA's 2 to 3% target band for inflation. And so with such a benign inflation outlook, we don't think inflation will be a barrier, but neither will it be a reason to cut rates. We see, I guess, overall risks are to the downside, but an upside risk we are watching quite closely is the pass-through of the currency into consumer prices. So the currency is down about 30 cents from its peak level, and so that raises the cost of importing goods into Australia. Now, those high import costs, however, haven't been passed on to consumer prices really yet. And part of that is just because demand is so weak. So if retailers want to raise their prices, consumers just won't pay it and they just don't spend as much. So while demand is weak, we don't see corporates being able to pass on the higher costs from the currency, but that's something we're going to watch closely.
Australia is closing in on the world record for the longest continuous period of economic growth, with 94 straight quarters without a recession. What has been the biggest economic success story for Australia during this period?
Yeah, so I think the biggest success story has been the labour market. So what we saw in the early 80s and the early 90s recessions is a really sharp rise in the unemployment rate. And in both of those recessions, we saw the unemployment rate peak around 10%. Whereas the last 15 years or so, in any slowdown, we've only seen a very modest rise in the unemployment rate, if at all. And even after a few years of below trend growth at the moment, unemployment rate is only around 6%. So I think that's been a big success story. The flexibility of the labour market means that instead of firing people when the economy slows, corporates are more likely to freeze wages or just cut hours.
Which of Asia's economies are likely to prove the most important to Australia in the coming years?
Yeah, so China's still likely to be the most important economy for Australia. Now, we sell over 30% of our goods exports to China. Japan is number 2. We sell about 15% to Japan. The other way that China matters to Australia is that they're an important source of international students into Australia. So a little known fact is that education exports are actually our 3rd largest export now. And so obviously that helps the Australian economy. International students not only pay fees, but they also spend on retail, they spend on hospitality, and obviously they spend on rents.
Activity in China's factory sector expanded slightly in June, while growth in the services sector sped up. How do you expect China's economy to perform for the rest of the year?
China's economy has stabilised, particularly in the very important property markets. Now, that's been helped by both fiscal and monetary easing by the government there, and our team expects further monetary easing over the next year to help just support momentum in the Chinese economy. Now, obviously, recent volatility in the Chinese share market has been in the headlines a lot recently. Now, we don't actually think it will have much of an impact on real activity, though. We didn't see a boost to consumer confidence as the share market was booming. So we don't think, as it has been more volatile, that that will necessarily weigh on consumer confidence and hence household spending. So overall for the year, we're looking for growth of 6.8%, so that's just a touch slower than 7% in the previous year, and that's kind of in line with this ongoing transition in the Chinese economy from investment-led growth to slower consumption-led growth.
There has been an increased focus on the growth of India. How important will India's economy be to Asia moving forward?
Yeah, so India's growth will be increasingly important to Asia's growth in coming years. So it's already the third largest economy in purchasing power parity terms in the world. And in fact, in coming years, we're expecting it to grow faster than China's economy. However, challenges remain. If it wants to grow at these very fast rates, it's going to have to reform its economy to avoid imbalances being created, particularly in whether it's fiscal deficits, current account deficits, or inflation. Now, last year, the Modi government was elected on a pro-reform agenda. Now, what we've seen is they've come into government, they have started to do some reform, but mainly it's the low-hanging fruit. It's the more easier reforms. So we see the challenge for them is to start tackling the more controversial, the more difficult, the more politically sensitive reform. In particular, we really see a need for them to start further reform in the infrastructure and also the agriculture sectors as soon as possible.
The US economy added 223,000 jobs in June, and unemployment fell to 5.3%, the lowest level in 7 years. How encouraging is this in terms of the overall US economic recovery?
Well, the labour market is one of the best indicators of the economy, and there's been a significant improvement in the labour market in the US in recent years. So the unemployment rate has fallen from around 10% during the GFC, and it's almost halved, as you said. It's just above 5% now. Now, this is important for the Federal Reserve, of course. They've been very encouraged by the continued improvement in the labour market. And I think it's near their objective of full employment. So meanwhile, while inflation still remains quite subdued, as the labour market continues to tighten and there are more signs that wages are picking up, they're getting more confident that inflation will eventually come through as well. So hence, our base case is that they will hike in September.
What is the latest on the state of the US housing market?
US housing market has regained momentum this year, and indicators of both prices and activity have really picked up. Now, there are a number of drivers here at play, so everything from pent-up demand to low interest rates, improving labour market, and also a tightening rental market, which is pushing up rents and making buying more appealing. I guess a key challenge towards the end of the year and into next will be how well it deals with rising interest rates. Now, the Fed is very aware of the challenge. We saw what happened during the taper tantrum in 2013 when mortgage interest rates just went up too sharply, and that really weighed on the housing sector. So the Fed's aware of that, and it's just going to raise rates very, very gradually.
What are the key aspects which will spark an improved US economy?
I think key to a sustained continuing US recovery is continued improvement in the labour market as well as a pickup in wages growth. Now combined, you should see a boost to the purchasing power of households, and households in the US are about 70% of GDP. So if you have them spending more, then that gives enough of a pickup in demand. If they're spending more, then that would encourage businesses to invest to respond to the increase in demand.
What has been the reaction to Greece's latest creditor bailout?
Yeah, so Greece recently reached an agreement with its creditors, and the agreement involves a third bailout package worth about 86 billion, and so that should actually meet Greece's financing needs for the next 3 years. So the reaction markets has been quite positive. You're seeing banks starting to reopen again. However, capital controls will remain in place for some time. Of course, in return for the bailout package, Greece has had to agree to new austerity and new reform packages. So that's everything from spending cuts to tax increases, pension cuts, and labour and product market reforms. However, this ultimately isn't a final solution, though, to Greece's problems. Fundamental problem for Greece is they have too much debt. So at some point in the future, there will need to be some kind of debt relief package.
What is the overall outlook for the EU economy in the next 18 months?
So while all the recent negative headlines around Greece may impact confidence in the short term, we think that impact would only be temporary. We think the euro area is in the middle of modest but increasingly entrenched recovery. So that's been supported by the lower exchange rate, by QE, and by reduced fiscal drag. And importantly, we're now starting to see business and household demand start to pick up. And at the same time, we're seeing banks easing their lending standards. So that means they're more prepared to lend to households and businesses. So that will help give this recovery another leg.
Thanks for joining us today, Katie.
Thank you for having me.